Good morning. It's MoneyWise Wednesday. Listen, y'all. Okay, within 24 hours after our predatory lending video from last week showed, we've had over 1,000 views on that one video. Thank you guys for checking in. Thank you for sharing. Don't forget to like and share. You're entered to win a $25 gift card. We got some winners from last week we want to do a shout out to. Congratulations to Angela Herndon and Kathleen Carter. You're going to hear from our team soon who's going to get those cards in the mail to you. And today we are talking about home ownership, mortgages, all that stuff. So I'm going to go ahead and just preface the lesson today. This is kind of a tough topic. We're going to be saying words that maybe you haven't heard before or you have heard but never really stopped to try to understand. We really do want to kind of break it down for you so that you guys as young people, when you get older, you already have kind of a general knowledge of what it's like to own a home and to think about mortgages, right? So some of you guys live in a home that your parents rent, or whoever you live with, they might rent. Or you might own your home, right? Some of you guys, your parents have a mortgage. Some of you guys, if they're lucky, they don't have a mortgage and they own their house free and clear, right? But most people, when they go to buy a house, they're going to need to borrow the money. Kelly has a lot of knowledge about mortgages in the sense that, unfortunately, her experience with the credit union is working in a role where maintaining or paying mortgages is a challenge for families. So Kelly, share with us real quick, why is this topic important? One, from your expertise, but also from your personal experience. Why do you think these kiddos need to learn about this topic and understand it now?
Kelly, that's a great question, because if you have the knowledge that we're going to teach you and that your parents have taught you, when you go into a home purchase, you'll understand what it takes to maintain that payment. And not just the payment of the house, but the payment of everything that goes along with the house, because it is one of the largest payments you will make in your adult years. And it is also one of the toughest ones to get caught back up if you end up falling behind and you don't reach out to your bank or credit union to discuss it with them before it gets too far gone.
Now, Herschel, as a financial advisor, why planning and knowing what we're going to learn today about mortgages is so important just for your overall financial health when it comes to budgeting?
The mortgage or home ownership process is intimidating to a lot of people because there are so many words. The length of the mortgage itself is scary. Like, who wants to enter into like a 30-year commitment, making this payment that could be substantial or it could be small based on your budget or your income and credit and things alike, right? So it's paramount, or it's very important, kids, that we share with you what it looks like, so it's not so intimidating when you start being exposed to some of these terms, and it's not so scary. Just slow it down, understand what you're entering into, educate yourself, and it's very easy to really truly understand that journey and take you along the way. So here we are, breath of fresh air.
Very cool. We're gonna hop on over, and you guys are going to watch the video with us and find out a little bit more about mortgages.
Hey, what's the big idea?
Oh, I'm sorry. I didn't realize you lived in there.
I don't. Well, not yet. I'm just here for the open house.
Are you gonna get it?
Well, I'm not sure. It kind of depends on the mortgage rates.
Ha! Good one. You're not joking. Sorry, I didn't realize hermit crabs need mortgages.
Of course we do. It's the biggest purchase of our lives. We usually need a loan to make it happen.
If I were you, I would just find the mortgage with the lowest interest rate and go with that.
It's not that simple. When shopping for a mortgage or any loan, financial institutions have products with an advertised APR, which stands for annual percentage rate.
That's what I mean. Just go with the one that has the lowest APR.
But you can't compare them at face value. The APR represents a combination of things. The interest rate, yeah, but also a wide range of additional costs. And if you're looking at an adjustable rate mortgage, the APR doesn't even tell you what your maximum interest rate will be.
You've lost me.
Look, Mortgages come in two basic types: fixed rate and adjustable rate, also known as variable rate. In a fixed rate mortgage, the interest rate is set when you take out the loan, and it does not change over time. The amount you pay monthly will stay the same for the entire term of your loan. In an adjustable rate mortgage, the interest rate, and therefore your monthly payment, is based on current interest rates in the economy. If the index they're based on goes up, so does your rate, meaning you'll be paying more. If the index decreases, so do your payments. An adjustable rate mortgage often has a lower initial interest rate, which is very appealing.
Fixed rate, adjustable rate, how do you choose the best one?
It's always a trade-off. Fixed rate mortgages are more stable and easy to budget for, but have a higher interest rate overall. Adjustable mortgages have better rates, but are riskier because your rate may increase over time. You have to think about your income, your future, how long you plan to live in the home, your financial risk tolerance, and that's on top of weighing different mortgage types, interest rates, and amortization schedules.
Gesundheit.
Huh? No. Amortization. It's how your loan repayment is broken down into regular installments over a fixed period of time. An amortization schedule shows you how much of each payment is going toward interest and how much of it is going toward the principal.
Is it that hard to figure out? If your interest rate is 3%, then 3% of your payment goes towards interest. Am I right? Your face is telling me I'm not right.
That 3% is the annual interest rate. If you take the total amount owing on your mortgage and multiply it by 3%, the result is what you'll pay in interest in the current year. But the monthly payments work a little differently.
What?
Let's say you take out a 25-year mortgage for $150,000. It's fixed rate, so you're paying $711 a month. In your first payment, $375 will go towards interest, and only $336 will go toward your outstanding balance. So even though you've made a payment of $711, your balance has only decreased by $336. The following month, because your outstanding balance is now $149,664, the interest portion of your monthly payment will also be slightly lower, and the principal portion will be slightly higher.
So looking at the entire stretch, even though a big chunk of my monthly payments are going towards interest at the start, over time, that kind of flip-flops. And by the end, more of my payment is going towards principal than towards interest.
Now you're getting it. Using this example, after 25 years, you will have made over $213,000 in payments on your $150,000 loan.
Whoa, that's serious.
All the more reason to know exactly what you're getting into before signing everything. People get into trouble by committing to mortgages they don't understand. It happened to a friend of mine. The bank came and took his shell away. He had to move into a half-eaten ice cream cone until he could figure things out.
That's rough.
Mortgages can be an empowering experience or a living shell. It all comes down to your understanding of the mortgage products available, honesty regarding your personal finances, and clarity about your life situation. As for me, this is a little too much home for my budget. Time to go house hunting. Keep it real.
Guys, so lots of stuff there, right, with demystifying mortgages here, talking about all these big words and all these steps in the process. Let's just start breaking it down. As Kelly told you guys in the beginning, buying a home is likely the biggest purchase you're ever going to make in your life. Most of us don't have hundreds of thousands of dollars laying around to pay cash for a house. So it's very likely that when you grow up and you purchase a home, you're more than likely going to need to borrow the money, right, from a credit union. And so we want to make sure we break it all down for you and help you understand it. So when shopping for a mortgage, financial institutions have products with an advertised APR, like you learned from the Friendly Crab in the video, right, with Jen. And just to remind you, APR stands for annual percentage rate. But the APR doesn't always tell the whole story. So you want to make sure that you understand the types of mortgages that are being promoted. Plus, there's a wide range of other costs to consider along with it, like insurance and taxes and any fees that might apply, what penalties come along with that particular product or mortgage type, and then any interest. you'll need to decide between a fixed rate and an adjustable rate mortgage. Let's talk about this a little seriously here, because some of you guys, you know, we've only known fixed rate. We didn't know that adjustable rate existed. But adjustable rate is also known as a variable rate. So first, let's talk about what fixed rate is. So think of fixed. When I think of fixed, I think of like a statue, right? It's concrete. It's not going anywhere. Well, it shouldn't go anywhere. But yeah, it's a fixed rate mortgage. So the interest rate is set when you sign the dotted line on what that rate is. That rate does not ever change over time unless you refinance it and roll it into a different product, right? But that particular mortgage, that rate doesn't change. The amount that you pay monthly will stay the same for the entire term of your loan, for the loan itself. We're not talking about property taxes. So if some of you parents are listening going, well, that's not true. You know, remember, we're only talking about the cost of the loan right now. We're not talking about those other things. So just the terms of the loan itself. An adjustable rate mortgage is based on a chosen index. So again, other big words, but the chosen index is basically a benchmark that reflects changes that might be going on in the national economy, right? So the adjustable rate is based on what the index is nationwide. If the index goes up, so does the rate and the amount of your payment. Okay, if the index goes down, so does the rate and the amount of your payment. Meanwhile, if you notice the fixed over here, like our anchor, that fixed interest rate stays the same the whole time, while adjustable rate mortgages are, you know, floating up and down depending on the index. So again, fixed rate stays the same throughout the entire term of the loan. It's consistent. It's easier to budget for. It tends to have a higher interest rate. It can, not always, but it tends to have a higher interest rate than maybe an introductory rate for a adjustable rate. So the reason why the rate might be a little bit higher compared to a variable rate in the beginning is because it already takes into account the effects of rates that could rise in the future. All right, so let's talk about that adjustable rate again. Adjustable rates, as we've mentioned, can change over time, and it's based on that national index. It usually has a lower advertised starting rate, and that's on purpose, and that's to help it become very appealing to you so that you take advantage of that particular type. A scary thing about adjustable rates, though, is that it is unpredictable. You don't know what the future holds, right? You don't know what the market holds for rates, and so it can be really hard to budget for that. So when we were talking about budgeting in our introduction, it's hard to know exactly what it's going to be. You don't know what the future is going to tell. So you want to think about, when you're considering the two options, really want to think about your income. You want to think about your future. How long do you plan to live in a home or live in a certain part, you know, of your neighborhood or your county or your city? Maybe you want to move states one day. You want to consider all of those things before you really decide on which type of mortgage is right for you as well. All right, so let's talk about how mortgage repayment works. So Kelly, tell us, what is an amortization schedule?
An amortization schedule is how your loan repayment is broken down into regular installments over the term of the loan.
Okay, so this schedule right here shows how much of each payment is going towards the interest and the principal. Herschel, real quick, what does principal mean? Are we talking about the principal of our school?
I wish that was the case when we were talking about mortgages, right? But in this instance, we're talking about the initial balance that the bank or the credit union gave you to make your purchase of your home. That's considered the principal balance. That's what that means.
Okay, great. So it's safe to say here then that the interest would be the fee or the monies that the credit union or the lender is earning from you as your repayment as a thanks for them lending the money to you in the first place, right?
Absolutely.
So this schedule then shows how much of, let's say you make one payment. We're going to give you an example here in just a little bit, but we give you one payment, right? Or you send in one payment, and then the credit union applies some of the money to the principal, and then the rest of it might be interest, which then goes into profit or capital that that particular lender is earning.
Correct.
So here's the example. Let's say that you have a $150,000 fixed rate mortgage, fixed at 3% APR, and it's amortized over 25 years. It's a hard word to say, I know. Bear with us. So amortized over 25 years, your repayment is going to be $711 per month. So remember, Herschel said at the beginning, it's crazy to think about having a mortgage for that long, to having a loan for that long. So I'm just going to throw it out here right here for you. I would love it if you guys would consider not doing a 25-year mortgage. Do a 15. Sometimes your rate is lower when you do a shorter term because it's less risky. But then you also are kind of, you live a little bit more within your means, right? And then if there's a, something that happens in the future, it's not as difficult for you potentially. Of course, the shorter your term, the higher your payment might be. So you got to take into consideration, what is your income, amount? How long do you plan to be there? How much equity would you have in the home if you purchase it right away? Which again, I'm throwing a whole lot more new things at you, but some of you guys are smart and you already know what I'm talking about. This isn't your first rodeo. All right, so using this example, your payment is $711 per month, right? Fixed rate mortgage. Again, we're just talking about the loan right now, which is the interest and the payment. We're not talking about your property taxes. We're not talking about your insurance. Those are all additional costs. Yes, they can be rolled into your monthly payment through your lender, but right now we're only talking about those things. So those things could cause your overall payment to vary in amount year over year or month over month or every 6 months, depending on how your insurance is paid and all those things. But right now, just talking about the borrower and the lender, this is what your payment would be every month until the loan is paid off in full. It's a long-term commitment. You should get real close and cozy with each other, right? All right. So this is how the interest is calculated for each payment. Real simple. You owe $150,000, right? Because that's how much you borrowed. The interest rate is 3%. So when you multiply the 3% by the 150 by the 3%, your annual interest would be $4,500. Divide by 12 months. And your interest in that current payment is $375. So imagine that of your $711 payment that you're making into that bucket, right? $375 is going to go to interest, and $366 is going to go to the principal. Now, because you've made a payment, right, your balance, your principal amount is going to decrease over time as you owe less and less on the loan. So don't get too confused by this. I know a lot of you guys are already doing your online learning at home, and it might seem a bit overwhelming to have to do all the math, but it's simple, simple, simple math, right? So as you see, as you make those payments on the balance over time and it decreases, you see that the interest also decreases over time. Do you see that? Because you owe less in interest because your overall balance is getting lower and lower. So that is a really good thing to get further away. That means more of your money is going to eventually start going to principal, right after the credit union is earning their interest. So big chunk of that monthly payment is going to go to interest at the start of the term, but over time, more of that payment is going to go back towards your principal. All right, so that 3% interest rate may not seem like much to you guys, but after 25 years, you will have made, listen to this, you will have made payments of $213,000 on a loan of $150,000 that you borrowed. So quick math, that means that you've paid a little over $63,000 in interest over 25 years. So you kind of see what I'm talking about potentially exploring options of a shorter term, right? Or a loan product that allows you to maybe have a less interest rate. So you got to consider what your options are, because we want more money in your pocket over time, right? We're not we're a nonprofit. We don't want to profit off of your funds. We want to help you accomplish your dreams and your goals and do it at the possible cost to you. Okay, so this kind of gives you an idea of what that looks like. So the next point is understand what you're signing before you sign it. People often get into trouble by committing to mortgages that they don't understand. All the more reason to know exactly what you're getting into before signing anything, okay? A mortgage can be an empowering experience. I think that we feel like we've arrived somewhere, you know, we feel like we've accomplished something when we have home ownership, but sometimes that can flip real quickly and feel a lot like a burden to people after the commitment that they've made, because maybe they didn't understand everything at the beginning, right? Or they find themselves in a life-changing situation that causes that particular situation to be a burden to them, right? So, Herschel, let's talk about budgeting real quick. So we've talked about in the past, leading up to this week, we've talked about understanding credit scores. We've talked about how to budget, right? So what would your advice be to someone who has never been a homeowner? What would you say their first step should be in preparing for home ownership? From a money standpoint, from a budgeting, go home and get your stuff together kind of scenario, what would your first step advice be?
Understand what you can afford. That is probably the best advice that I can offer. Very simple term, very simple word, very simple to understand. Understand what you can afford. It's very, very risky out there when you start getting these numbers from lenders that you can potentially purchase and you feel like you can go out and make that purchase. Kelly, understand what you can afford. I'm gonna end with this. I'm excited to talk with the adults about home ownership later on this afternoon. I really feel like we're going to be able to hit it home with them about the big picture of understanding what you can afford. Thank you.
So I want to show you guys some handouts that really complement this session well. So as you can see, I'm not going to go through all these. You guys can pull this up on your own. I really encourage you guys to go here. It's envisioncu.com/moneything, and you can find the mortgages. It's the one with the little house picture. You guys can see this topic here. So, okay, so really good, just really good things to ask yourself here. And, you know, like Herschel was saying, really good, honest moments, like being honest with yourself, asking yourself questions. I really encourage you guys to talk to your parents,
Please.
Talk to your grandparents, talk to your aunts and uncles, ask
Please.
them, you know, hey, you know, grandma, like, what made you, like, how long have you owned this home? Do you own anything on this home? No, well, obviously we don't want to press too much. So y'all be kind, be nice. But, you know, there's a lesson in it for all of us, because many of us as adults, we've made good decisions regarding finances and mortgages. Some of us have made bad decisions. Some of us maybe don't understand everything. So y'all talk about it together. Could be a good opportunity. And like Herschel was saying earlier, you know, we're going to be talking to your adults about this at 12. Okay, so at noon today, we're going to have the adult topic. So this is a good opportunity for you guys to have shared conversations about the topic. We would love for you to have a home one day and for you to own it. But if you don't want to, that's okay. Rent, because you'll have plenty of opportunities and plenty of options, because there's a lot of investors out there that want rental income, right? So final thoughts, anybody?
Yeah. So what I would like to say is, even if you don't have any intentions, you guys are all young, you might not be thinking that far ahead, but use these tools that we've given you over the last couple weeks, the credit reporting, your budgeting. So use it not just with the home buying, but with all your financial decisions.
Yeah, absolutely. Very good. Well, thanks everybody for joining us. Don't forget to like and share the video. Let's try to surpass last week's video in the first 24 hours. Over 1,000 views. I'm just blown away. Let's just, I'm curious to see how far this one's going to go, but like and share it. And please comment below. And we've got some special topics coming up in the next few weeks. We can't wait to bring them to you. You'll continue to watch them right here every Wednesday, 10 a.m. We'll see you next week, guys. Bye.